Good morning, students. This is faculty CMA Bhavadhavan. I'll be taking the topic of Introduction to Cost and Management Accounting. So we'll be starting. This is the first introduction, basically to the subject Cost and Management Accounting. So we'll be starting with this basically the subject has all the concepts of costing and what all you will be learning in the whole subject. So the overview of everything I'll be giving you in this session today in the introduction to cost and management accounting. So let's start. The overview, basically, first of all, what we'll all be learning in this session, introduction and meaning of different concepts, various cost concepts, and what are the techniques of costing, what are the methods of costing, what are the difference between costing and other disciplines of finance and cost. So objectives of cost and management accounting, then we'll be understanding the scope of cost accounting. Then, of course, the relationship of cost and management accounting with other discipline. All right. So the management accounting, the financial management, the cost accounting with different other disciplines. Users of cost and management accounting. So who are actually will use the information which cost and management accounting gives. Use of IT in costing. So IT has a fundamental role these days in costing. It has eased the whole process. The cumbersome process has become very easy now. So that is all because of IT. The various cost objects, responsibility centers, cost classification. So where you will be learning a lot of concepts of different types of cost. And of course, last but not the least, I've kept some exercises also to just brush up what all we have learned in this session. That will be the end of the session. So we'll be starting with the introduction and meaning. So there are different cost concepts and exactly what is the, what they all seem to be, very related. But every meaning, every concept has some difference and some significance attached to it. So first of all, of course, cost and management accounting, we have to understand what is cost. So cost is basically the amount of expenditure incurred or attributable to a specified article, product, or activity. So cost is basically the expenditure in quantitative terms, how much the expenditure we have incurred. It can also be to ascertain the cost of a specified thing. So cost is basically the expenditure also, and cost here also means how we ascertain the cost, all right? How we find the cost. So that is also the meaning of cost here. So cost, of course, lot of cost we have to understand. So everywhere in this session and in your cost and management accounting, everything has to be associated with cost. So costing, what is costing? Costing is basically the technique, all right, and process of ascertaining cost. So the technique, how we are going to ascertain the cost, how we are going to find out the cost, that is costing. So costing is basically the technique we are going to understand in this session. It provides the information that management needs to plan and control all organizations' activities and make decisions about the future. So basically, costing gives a whole lot of information to the management about the cost of the product or the service or any department or any job or any contract or whatsoever. So costing is basically a technique that is going to give a lot of information to the management for decision making, right? Now, cost accounting. Cost accounting is basically the whole process of accounting for cost, which begins with the recording of income and expenditure, like we do in financial accounting. Financial accounting is also a part of recording. So cost accounting is also a part of recording. So what all bookkeeping we understand, cost accounting is actually all those recording and bookkeeping. So we have the cost of different products or different cost objects. We have the cost with us. Now, as we have ascertained the cost, now how to basically record that income and expenditure and cost so that they are calculated and they end with the preparation of periodical statements. and report. So cost accounting is all sort of recording, then making all sorts of periodical statements and reports, again for the management, for the users of the cost accounting, for decision making, for controlling costs. So all this aspect of recording comes under cost accounting. Cost accountancy. Cost accountancy is basically the application of costing and cost accounting principles. So what all principles and methods and techniques we have, we apply those. So all those application of those methods and principles and practice for cost control and ascertainment of profitability. So basically it includes the presentation of information. So cost accountancy is basically we apply all the methods and techniques and we present how the information has to be presented. It's derived from the purpose of managerial decision making. So that is the four concepts: cost, costing, cost accounting, and cost accountancy. All right. Let's move to the next slide. Management accounting. Management accounting is more of the application of principles of accounting and financial management. All right. So management accounting is, see, wherever management accounting comes, it has to be the information that is available or that is useful for the management of the organization. Right. So basically management accounting is the application of the principles of accounting and financial management to create and to protect and to preserve and to increase the value of the stakeholders. So whenever management accounting comes, whenever management comes, that means it has to do something with the stakeholders or the shareholders or whosoever has invested or whosoever has to do with the organization. Whosoever has any interest with the organization, maybe the lenders or the borrowers or any user of the organization or the information. So management accounting is basically to increase the value of the stakeholders. All right. For the profit or non-profit organization, both type of organization, management accounting is basically, and of course the public and the private sector. The management accounting is an integral part of the management function. It assists management by provision of relevant information for planning, organizing, controlling, and decision making. The management accounting gives all sorts of information to the management for these functions: planning, organizing, decision making, controlling, etc. Cost management. Cost management is the application of management accounting concepts, methods of collections, analysis, interpretations of data to provide information needed to plan, monitor, and control costs. So cost management is whatever we do, the purpose is basically to plan, monitor, and control costs. So cost management, the whole focus is not on the stakeholders. In cost management, the whole focus is on basically to control the cost, to monitor the cost continuously and consistently. So cost management focus is on the cost. Management accounting, the focus is everything in the cost has to be basically to increase the value of the stakeholders. So that is how it goes, the introduction part. Objectives of cost accounting. Basically, what actually cost accounting is going to give us: ascertainment of cost. The first and foremost function and objective of cost accounting is to ascertain the cost, to find out the cost. All right. Determination of selling price and profitability, cost control, cost reduction, assisting management in decision making. So basically, some of these objectives are very, they are very evident what they are going to do. Cost control and cost reduction. Again, very important concepts: cost control and cost reduction. Cost control is basically as per the standards set, and cost reduction is a continuous process. All right. They basically, cost reduction, we always focus on the reducing the unit cost. Unit cost means per unit cost, we should reduce it. So we always find the scope of reducing the per unit cost. That is the overview of the cost reduction. So we'll be, learning more into it. So ascertainment of cost, of course, how the costs are ascertained. We accumulate the costs first. So all costs here and there, we gather all the costs, we accumulate all the costs, we assign the costs, and then we ascertain it for each cost object. This cost object may be a unit or a job or operation or process or department or service. So any which way we want the cost, let us say we want the cost of a product. So every cost will be accumulated and then it will be ascertained. Or we can we just want the cost of one job or one operation or one process. So let us say a raw material passes through three processes before it becomes a finished product. All right. So for every process, I need a different costing. For process one, I want to know the cost. For process two, also I want to know the cost. For process three, also I want to know the process, because in every process there will be value addition, and of course there will be different costs respective to that process. So that is the whole idea about ascertainment of cost. So it depends upon the requirement of the organization. We want the cost for one unit, for one product, for a service we are giving, for one particular job order which I have received, or I want the cost for one department. If there are 5 departments in an organization, could be purchase department, could be production department, could be stores department, could be finance department. So the management would like to know the cost of each department, how much cost each department is incurring. All right. The whole objective for ascertainment and accumulation of cost is basically at the end of it to have cost control also, because at every stage cost is being monitored. That's part of cost management, right? And of course, for anything, for any cost object, we want to ascertain the cost. Determination of selling price and profitability. See, although the selling prices are determined by external factors also, but yes, cost accounting gives the base of it. Cost accounting says, okay, the selling price cannot be less than 100. So the base the cost accounting can give. So this 100 is the total cost of the product. So selling price has to be more than 100. So of course, there are different factors. There are more factors to determine the selling price of a product. But yes, the cost of a product also has its role in determining the selling price. So cost accounting system provides the basis for price fixation and rate negotiation. So we actually know where to start to fix the selling price. Cost control. Cost control ensures that expenditure are in consonance. Consonance means they're in alignment with predetermined set standard. See, for every cost basically segment, we have a predetermined set standard. Okay, so if we have to, you are calculating the material cost. This material cost cannot be more than 5,000. So we have a set predetermined factor that this is the standard for the material cost. So if the material cost is going beyond 5,000, that means there has to be something for cost control. So the cost should be controlled. Why it is going beyond 5,000? Because when the costs are, certain standards are set, certain predetermined standards, if they are set as per many factors. I mean, it's not very randomly they are set. Very technical analysis is done, then only predetermined standards are set. So if that standard is rupees 5,000 for material, there has to be some analysis behind it. So when the actual material cost goes beyond 5,000, that means why there is a deviation, why there is a variation. So there has to be something has to be worked out to bring down the material cost below 5,000, or it should not be more than 5,000. So for example, this is just an example I'm giving. So cost control is basically the expenditure should be vis-a-vis the predetermined standards which have been set for that particular type of cost. All right. Any variation from these set standards is noted, and then they are reported on continuous basis. They are monitored on continuous basis. Why this variation? Why this deviation is coming? To exercise control over cost, how is the basis of the cost control process? We have the standard cost or standards for certain elements of cost, and then when they are actually incurred, so we measure the actual performance. So how much is the actual material cost? How much is the actual labor cost? And then we compare the actual with the set standard. So we have the standard set with us. Then we have the actual cost with us. When we determine the cost, we ascertain the cost, we have the actual cost. Then we compare the predetermined standard and the actual, and then analysis of variance and action on it. Why there is a variance, why there is a deviation. So that is basically the cost control, which is monitored. So cost control basically looks for the least possible cost. But yes, always, whenever we say we want to minimize the cost, we want to control the cost, and continuous efforts are being done by the cost accounting department and the management to control the cost. But always remember, everything is done without compromising the quality. So if we want to minimize the cost of raw material, that does not mean that the management will buy the inferior quality of raw material to bring down the cost. No. So the cost control happens, but without compromising the quality of the product or the whatever cost variance or deviation we are looking for. All right. So it always has to be as per the specifications. We cannot compromise the quality and the specifications which we require for the organization. Right. So moving further, cost reduction. So they seem to be very similar, but cost reduction is totally different. It basically deals and focuses on to reduce the unit cost of a product. Right? So let us say if a marker or a pen comes for 50 rupees per unit. So cost reduction will be how to bring down the cost per unit of a product. All right? That is a cost reduction. So it is defined as the achievement of real and permanent reduction in the unit cost of the goods. So this unit cost is a very important factor in cost reduction. For unit cost of goods manufactured or services rendered without impairing their suitability for the use. So again, without compromising the quality, without compromising the utility or the suitability. Yeah. Or diminution in the quality of the product. Diminution means decreasing or compromising or sacrificing the quality of the product. That is not done. Only the cost reduction, the unit cost will be reduced, but without compromising the quality. No cost is termed as lowest, and every possibility of cost reduction is explored. So, see, under cost control, we basically aspire to have the minimum minimum possible cost. But in cost reduction, they say that there is no such minimum cost. There is always a scope to further reduce the cost. That's the basic difference between cost control and cost reduction. So cost control always, okay, what is the minimum possible cost? Whatever we have reached to the minimum possible cost control is satisfied that, okay, we have achieved the minimum possible cost. But cost reduction says there's always a further scope to reduce it further. And yes, it basically focuses on reducing the unit cost of the product. So to do cost reduction, the following action is taken. Each activity within an entity is segmented to analyze and identify value-added and not value-added activities. All non-value-added activities are eliminated without affecting the essential characteristics of the product or process, then conducting continuous research and study to know the most optimal way to manufacture a product or render a service. So cost reduction is basically the whole lot of process to minimize or to have a permanent reduction in the unit cost. So the processes, the manufacturing processes is carefully monitored. Every process is monitored. Like where to minimize the non-productive activity. So see, every process has some productive activity and a non-productive activity. If let us say machine is running and the products are getting manufactured. So that means it's a productive activity. All right. Non-productive is like machine has to get repaired immediately. So that is a non-productive activity. During that non-productive means during that time there is no manufacturing operation going on. So non-productive activity is actually a cost for the organization. So cost reduction aims at minimizing these non-productive activities. Let us say a laborer is working, the labor needs rest also. So when the laborer is working, it's a productive activity. So then they monitor how much time the laborer takes to rest. So let us say the laborer is taking 15 minutes time to rest. They can reduce it to 10 minutes. So basically they try to eliminate or reduce the cost of non-productive activities. So if the laborer is being paid for an hour, all right, and in that particular hour, 15 minutes, during the break time, he's taking 15 minutes extra break. So that means that it's a non-productive cost being added to the organization, because during that time he's not contributing to the manufacture or to the production, right? So cost reduction process basically deals with monitoring very, very closely every activity, every process, so that non-productive activities or non-value added activities should be eliminated or should be minimized. So when the non-productive activities will be minimized, of course, the cost is going to decrease, right? The cost to the organization for that particular product. So that is the whole scenario of this cost reduction. Assisting management is decision making, of course. Objectives of cost accounting is giving all sorts of information to the management in the form of periodical statements, in the form of reports, in the form of stock reports, and any different form of reports that the management wants from the cost accounting department. So all this information is basically for decision making. The cost and management accounting, by providing relevant information, assist management in planning, implementing, measuring, controlling, and evaluating of various activities. A robust cost and management accounting system provides internal and external information to the industry, which will be relevant for decision making. So that is all about the objectives of cost accounting. Let's move further. Cost control and cost reduction. So we can, I've explained you the concept. So let us very quickly basically just do the difference between the two. Cost control aims at maintaining the cost in accordance with established standards. So the basic difference is, in cost control, there has to be certain predetermined standards from which we measure the actual performance. In cost reduction is concerned with reducing costs. There are no predetermined standards, but it's a continuous process of reducing costs. It challenges all standards and endeavors to improve them continuously. Second difference, cost control seeks to attain lowest possible cost under existing conditions. The cost control is like, okay, this is the minimum possible cost. We'll try to reach the minimum possible cost. In cost reduction, it recognizes no condition as permanent. In cost reduction, they say there is no minimum possible cost. There's always a scope to further reduce the cost. All right. Since changes will result in lower cost. All right. In case of cost control, emphasis is on past and present, of course. So because when predetermined standards are set, they are set as per the past trends only. So how much was the material cost in the past? Based on that, the predetermined standard is set. So cost control is basically on the information taken from the past and then between the present. So the standards are set as per the past experiences, and the actual performance is based on the present. So it's between past and present, but cost reduction is on present and future. So basically we are trying to minimize the unit cost for the future. All right, on the information, on the processes, on the activities which are going on in the present. So present and future. So that is the very fundamental difference between cost control and cost reduction. So cost control is a preventive function. All right. Preventive means it has to be, there should not be any corrections or rectification. So preventive means that we are already, comparing the actual with the standards. So of course, there will not be, higher costs. So to avoid the higher cost in the future, we are doing the preventive functions here. Cost reduction is a corrective action. So corrective action means why this time lag in the production, why the machine is kept idle, why the laborers are sitting idle. So basically, it's a corrective action. So whatever is going wrong, we have to fix it. That is cost reduction. So it operates even when an efficient cost control system exists. So we have a cost control system, we have a predetermined standards, but again, cost reduction goes parallelly. Cost reduction says there is also a gap, there could be a gap in those standards also. So they challenge the standards also. Cost control ends when targets are achieved. So cost control says, okay, this is the lowest possible cost and we have achieved it. But cost reduction says there is no visible end. It's a continuous process. There is still scope. So whatever is the minimum, there is no minimum. There is further scope to reduce the cost. So that's the difference between cost control and cost reduction for you all. Then we're moving to scope of cost accounting. So scope of cost accounting, again, for costing purpose, for cost accounting, we have already done these concepts in the previous slides. Costing, cost accounting, cost analysis, cost comparisons, cost control. Again, we have just done cost reports, all those reportings and all those statements and reports which always the management asks for decision making, and of course statutory compliances. So what all costing compliances from the government or from the act we require, that all we're going to understand here. So costing, we have already understood that it's a technique. All right, and process of ascertaining this cost of products and service. So costing is all about the technique and all the process we follow. Different techniques we follow. That all under comes in the purview of costing. Let me just quickly take the queries. Okay, so I'll just. Okay, standard costing. So some of the students are asking for standard costing. So yes, standard costing we have whatever standard costing, of course, is the technique of costing, and we'll be learning this is an introduction chapter. So introduction will give you the overview of all the concepts and techniques and methods. And yes, every technique you will have a different chapter in the future units. All right. So consonants. Consonants means in alignment. All right. In alignment means that it should match. All right. I hope you understood. So in consonants means in alignment, or it should match with the standard. So that is the meaning of consonants. Some of the students asked. So this is the scope of cost accounting we were doing. So costing, of course, is the technique. Cost accounting, again, I've already explained. It's the process basically for recording of cost. Like we record the expense and income and expenditure in financial accounting with all those journal and ledger. I hope you know all that. So that is again the part of financial accounting recording. Cost accounting is also the recording part. All right. So all those preparation of periodical statements we make and reports we make. So it's a formal mechanism of cost ascertainment. So we follow the statement, we follow the format, we follow the formulas, we follow the techniques. So with every reports and every format, how the cost is ascertained. So we have a set format for that. We have a schedule for that. For all those comes under cost accounting. Cost analysis. Cost analysis is basically finding out the factors responsible for variance in actual cost from the budgeted cost, and accordingly fixation of responsibility for cost differences. And this helps in taking better cost management and strategic decisions. So very, very interesting. Basically, this line, fixing responsibility for cost differences. See, there is a manager for every department, for every cost center, there is a manager. So for every cost center, the cost will be ascertained, the actual cost is going to come. So why there is a variance? So I told you, cost control basically starts with the predetermined standard. And when the actual cost or actual performance is compared with the predetermined standard, there has to be some deviation, there has to be some differences, some variances. So the manager is answerable, or whosoever is taking care, whosoever is responsible for that particular cost is answerable. Why there is a deviation? Because the predetermined standards are also set as per past experiences only. So when earlier this particular cost should be there, why this time the cost has increased? So cost analysis basically gives a base that why this variance, and the person responsible is accountable. He has to answer why there is a deviation, why there is a variation in the cost. All right. So that is all about cost analysis. Moving further, cost comparison. Very interesting. Cost accounting includes comparisons of cost involved in alternative courses of action. So cost, on a regular basis, whenever let us say I want to buy raw material from a vendor. So I will not buy raw material. Just I go to the the storekeeper or anybody will go to the market and buy the raw material. We compare the cost of, let us say, different vendors. So I will fetch the requisition or the orders from the purchase orders or the bids from various vendors of raw material, and then I'll select the best possible vendor who will give me the minimum cost, of course, without compromising the quality of the raw material which I want. So cost comparison means we compare the cost with alternative courses of action always. That okay, why if I do this, so alternative A, alternative B, alternative C, all the three alternatives, I find out the cost. Then I will choose the best alternative. So of course, which will have the minimum of cost without compromising the suitability or the utility or the quality of the product or the service or whatever. Such as a use of different technology. So we also compare the cost. If let us say we use a different technology, then what is the cost? So different technologies have different costing. Okay, so that is the whole scenario. Like we compare the cost for alternative courses, for different technology, cost of making different product or service. If I make product A, if I make product B, if I make product C. So what is the cost of all the three products? So or, all right? So we always have alternatives. Whatever we do, whenever we invest also, whenever we go to buy anything in the market, we always compare the cost. So that exactly cost accounting also does. So we do cost comparisons or different factors of same product or service over a period of time also. So different products also we compare the cost, or we compare the cost of a product over different period of time also. So let us say in 2019, what was the cost of product A? Then 2020, what was the cost? So over a period of time also we compare the same product but cost at different period of time or different years. Or we also compare the cost of different products. Or we compare the cost if we produce it with a different technology. So any which way we have a scope of comparison of cost. All right. Cost control, I've explained in detail. So again, just have a brush up of this concept. Cost control, detailed examination of each cost in the light of advantage received from the incurrence of the cost. Thus, we can state that cost is analyzed to know whether cost is not exceeding its budgeted cost. Budgeted means whatever the standard we have set, and whether further cost reduction is possible or not. So cost control again. So whenever cost control will come, it has to be like we compare the actual with the predetermined standard or the budgeted cost. All right, so always remember this. Cost reports. Again, the scope of cost accounting gives, making of different form of reports which the management wants. So this is the ultimate function of cost accounting. These reports are primarily prepared for use by the management at different levels. So different levels of management need reports, different form of reports, all right? So higher management or top management wants reports for strategic decision making. Let us say to invest in a new factory plant or to buy a new machinery. So all these things, if let us say the production has to increase and there is no capacity in the existing factory, so they have to make more investment. So they will have to have the information that why we should go for a new factory plant. So the cost accounting department will submit the report. Okay, so this much orders we are expecting, these huge orders we are expecting, in the coming months. So we have to expand our factory plant or the machinery setup. So, these reports actually help the management for decision making. So cost reports help in planning and control, performance appraisal, and managerial decision making, of course. So everything for different sort of purposes, cost reports are given to the management. And statutory compliances, they are in every department. They are in financial accounting, there are different compliances. In company law, there are different compliances. In taxation, there are different compliances. And same for cost accounting also. So maintaining cost accounting records as per the rules prescribed by the statute means the law. To maintain cost records relating to utilization of materials or labor and other items of cost is applicable to the production of goods or provision of services as provided in the Act and Rules. So basically, all the reports and the formats and the cost accounting records are made as per the format which is prescribed, like in any law and any act. So there are, for financial accounting, we have different rules and different principles and different format and different schedules. In Companies Act, we have different schedules. Same way, we have different schedules and reports as provided by the Act. So we have to follow the same format and same reports. What all reports are applicable, we have to make that. So that is all for the scope of cost accounting. Okay. CMA is, so a student is asking what is basically CMA. CMA is the Cost Institute of Management Accounting. That is an apex authority basically in UK. So that is CMA. We follow different, it's a very, very good cost and management apex association, which, the countries globally follow the rules and the guidelines which are given by CMA, all right, CIMA. So that is the query. Okay, let us move further. So relationship of cost and management accounting with other disciplines. Now understand the relationship of cost accounting. So we know the financial accounting, we know the financial management, we know the management accounting. What exactly is the difference between the two? So quickly we can understand this. It records the quantitative aspect only. So cost accounting, of course, it just knows the figures, it just knows the cost. So cost has to be quantitative, right? And in management accounting, it records both qualitative and quantitative aspects. So basically, it deals with the how much the time or how much behaviors and attitudes and everything. So management accounting deals with decision making and performance appraisal. So attributes are also important: behavior, temperament, performance, motivation. Everything is important for management accounting. But for cost accounting, they just know the figures. The money figures. So everything that is money measured has to be part of cost accounting. In cost accounting, it records the cost of producing a product and providing a service. So cost accounting basic, if we have done the objectives, if you remember, the first objective was ascertainment of cost. So basically, it records the cost of producing a product. And in management accounting, it provides information to management for planning and coordination. So every information goes from cost accounting to the management for decision making. It only deals with cost ascertainment. It is wider in scope. Management accounting is wider in scope. It includes financial accounting, budgeting, taxation, planning, and everything. So, of course, management accounting is basically the management focuses on accounting. So, accounting could be cost accounting also, accounting could be financial accounting also, accounting deals with budgeting also, it means taxation also. So, management accounting, of course, the scope is much, much wider. Cost accounting is a part of management accounting. So cost accounting is basically the ascertainment of cost. So it's just one segment of management accounting. And of course, management accounting is much more than just cost accounting. It uses both past and present figures. Management accounting focuses with the projection for the future. So cost accounting deals with the past experiences to set the predetermined standards and for the present cost, the actual cost. Management accounting focuses on the present figures to make projection for the future. Projection means estimate for the future. So management accounting is basically for decision making. Cost accounting, its development is related to industrial revolution. Its development is related to the need of modern business world. So cost accounting is going from traditional years and when industry started, then cost accounting started. Management accounting is basically they always, change themselves, they adapt themselves, they update themselves for the ever-changing modern business world. So management accounting has to be really very fast-paced, all right? Like the business world is changing every day. So cost accounting, again, it follows certain principles and procedures for recording cost of different products. They have to follow the principles and the techniques and the methods because we have to record the cost here. But it does not, management accounting does not follow any specific rules and regulations. based on the reports they get from different accounting departments, reports they get from cost accounting department, reports they get from taxation department, reports they get from financial accounting department. So they have to make the decision making for planning for the future. So there is no set rule or standards, right? But of course, cost accounting has to follow the rules. So moving further, difference between financial accounting and cost accounting. So must be doing financial accounting also. So must be aware of financial accounting. Financial accounting, this discipline, is the first discipline that a commerce student is basically encountered with, because cost accounting comes later. So we always start with vouchers and accounting equations, then journal entries. Every commerce student is familiar with it. So financial accounting is basically, we know what financial accounting is all about, but let us understand the difference also. Financial accounting provides information about financial performance of an entity, all right? Profit or loss, balance sheet, trading account, manufacturing account. Cost accounting is ascertainment of cost for the purpose of cost control and decision making, right? So it is basically focuses on cost, and financial accounting focuses on financial performance, more about the profitability. Cost accounting does not, understand profitability to a certain extent. Their only focus is on cost. Cost ascertainment, cost control, cost reduction, cost monitoring, everything relates to cost. Financial accounting, of course, it basically strives for best financial performance. Financial accounting classifies records, present and interprets transactions in monetary terms. It classifies cost records, present and interpret in a significant manner. So basically, both have different interpretations, both have different records, both have different classifications, both have different format as per the requirements of their different act which they apply to. All right. It records historical data. Financial accounting records historical data. That means what already has been done. It makes use of both historical and predetermined costs. So financial accounting, we make trading account, profit or loss account, we pass the journal entry, we pass the ledger, everything that has already been incurred. So expenses have been incurred, incomes have been, they have earned, income we are receiving, expenses we are paying, then only we record them in financial accounting. But cost accounting, we actually have the predetermined rates also. So in cost accounting, we have both historical and predetermined. Historical means which has already been done. That is historical. All right. The users of financial accounting statements are shareholders, creditors, financial analysts, governments, and agencies. Cost accounting information is generally used by internal management. That is a big difference. But sometimes regulatory authorities also. But financial accounting users are more external than internal, but cost accounting are more internal than external, broadly. All right. Financial accounting shows profit or loss of the organization, either segment-wise or as a whole. Right. It provides cost accounting provides cost details for each cost object. So cost accounting gives the details of cost for every product or process or job or contract or service or operation, anything. It means that it gives the details of the cost. But in financial accounting, we calculate the profit for the whole organization. In financial accounting, financial statements are prepared usually for a year, but cost accounting reports and statements and records, basically we can make anytime. We can make weekly reports also. We can make fortnightly reports also. We can make monthly reports also. We can make 6 monthly, annually, semi-annually, for any time, for any period you want any report. Cost accounting report generate those type of reports. So again, there's a very interesting difference between the two. Financial accounting records are generally made for a year. So profit or loss account for the year ended. Balance sheet as at that particular date. So, but cost accounting records you can generate anytime you want, for a week or for a month or for any period which you may like, right? So moving further, the users. Shall we have any queries? Users of cost and management accounting. So internal users. So we just discussed that cost and management accounting, cost accounting is basically the users are more internal than external, but of course external users are also there. but mainly this is for the management for decision making. So the managers use the information to know the cost. So first of all, the management wants the cost of a cost object. Cost object means maybe for a product or for a service or for a job, etc. And cost center. So for any cost center, let us say production department is one cost center, purchase department is another cost center. So the management uses this information to know the cost of a product. That means any cost object, it can be any cost object, or for any cost center. That means could be any department also. To know the price for the product or service, of course, if we know the cost, it's always easy to fix the price also. So to fixing the price, we need the cost. To measure and evaluate the performance of responsibility centers. So a cost center is part of responsibility center. Responsibility center means every department is headed by a manager or whosoever is taking care of that department. So that the responsibility of that department lies with that manager. So the manager is accountable and answerable and responsible for every cost that is being incurred in that particular department. So responsibility center means that we will be doing responsibility centers in the following slides. Then to know the profitability, product-wise, department-wise, customer-wise. So any which way, we just told you any sort of reports can be generated as per the requirements of the management. If the management wants, we want department-wise report, we want product-wise report, we want profitability of this responsibility center, or we want the report customer-wise. So basically, the reports in the cost accounting department can be conditioned as per the requirements of the management. It's so flexible. That is the best part of cost accounting department. They can generate reports any which way you like. That's not very easy in the financial accounting department because it's basically based on annual basis. All right. And yes, to evaluate the strategic options and to make decisions. So all these functions or the uses for the management is very important. Then operational level staff. Let us understand why the operational level staff need the cost and management accounting, why they actually require that. The operational level staff like supervisors, foremen. Foremen means who basically handles the tools in a manufacturing setup. In a factory, who will handle the tool, who will give the tool to different machines for running the machine. So every foreman is there who takes care of all the production activities going on in that factory area. Team leaders require information, what they require. To know the objectives and performance goals for them. So let us say there is a manager of a particular department. Now that manager is going to tell all the operational staff who are basically helping them in the production of that particular department. So the manager will say, okay, this is your performance objective, this is your performance standard, and you have to achieve this. So that is how the operational level staff is also basically key and a very integral part of the whole cost accounting department. Because they come to know that what is expected out of them, as simple as that. What they have to deliver, what is expected out of them, what the management expects from them. So for them, that is why they should know the objectives of the department, the objectives of the requirements, and the performance goals. To know product and service specifications. So let us say they are producing a product. They should know what that product is, what the specification of that product is, which they are working on. So they should know all the details of the product or the service which they are working for. So that all information is cost accounting department actually gives them. So to know product and service specifications like volume and quantity and the process and everything, what all are the requirements for that product, which type of raw material is used for this product, how much days it takes to manufacture this product into a finished product. So, how the whole scenario, the whole production process, everything they need to understand. To know the performance parameters, again, which their performance is measured and evaluated, of course. So for their performance appraisal by their manager and then by the higher management authorities. So they have to be on their toes, that they should know what is expected of them, and this is the performance standard, and this they have to achieve, and this is the minimum that they have to do and they should do. To know divisional profitability, etc. For every responsibility center, they have to see, every responsibility center has their own share of everything, of responsibility, of profits, of costs, and everything. So it's the performance standards of everybody from operational staff to the manager of that center. Center means department, right? Employees. So employees are concerned with the information related with time and attendance, incentives for work, performance standards again. So whenever we talk about the staff or the employees, the first thing should come to our mind is performance standards. So every department, whether it's cost accounting or financial accounting, every employee which is working in each and every department has their performance standards fixed for them. So they have to achieve them. And of course, then the time and the attendance, at what time they're expected to come, at what time they're expected to leave, how much, how much minimum attendance is mandated, and every other thing. So again, the employees also have an interest in cost accounting department, which work in them. Regulatory authorities, now the external users. So regulatory authorities are concerned with cost accounting data and information for different purposes, which includes tariff system determination. Tariff means the rate. All right, let us say the rate of excise duty or the rate of custom duty or any tariff for that matter, which is applicable to that particular organization. Providing subsidies. So the government basically gives subsidies to many factories or the many organizations or many companies. So, and many industries. The government gives subsidies. So cost accounting data actually helps the government also to decide, okay, this industry will get this much of subsidy. So let us say they don't have funds, but they need funds. So government gives subsidies to the industries also. So their cost accounting data is relevant for deciding for the government also, how the company is going, rate fixation, etc. Auditors, of course, the auditors, while conducting audit of financial accounts or some other special purpose audit like cost audit. So normally they have statutory audits which are done for financial accounting, but yes, cost audits are also being done. Require information related with costing and reports reviewed by management. So if there is a cost audit going on, so relevant reports are required by the auditors. So all those reports are from the cost accounting department only. Shareholders, of course, management communicates to shareholders through periodic communication, annual reports, etc., regarding new orders received and product expansion and market share for products, of course. So the shareholders also have an interest that, okay, if any new product is getting launched or, any particular new market you have captured, and what have the market share been increased, or have we getting, let us say international orders or the export orders are we getting? So all this information is important for shareholders also. Because it basically adds the value to the organization. So everything that adds value to the organization, the shareholders are interested always. And creditors and lenders, of course. So creditors and lenders are concerned with data and information which affects an entity's ability to serve lenders or creditor. For example, any financial institution which provides loan to an entity against book debts and inventories. So let us say if somebody is going to give me loan and they want to give the loan against the inventory or the inventory I'm maintaining. So they will see how much inventory I'm maintaining. All right. So if they want to give loan against that inventory, they should know what minimum level of inventory I always maintain. So similar information the creditors or the lenders might want if they want to give loan to our organization. I'm more concerned with regular reporting on net debt position and stock balances. So all these, of course, the requirements of the creditors and the lenders. No queries as such. We'll move forward. So we have done the users of the cost and management accounting, internal and external users. Moving further, use of IT in costing. So use of IT in costing means information technology has changed the scenario all over, especially during COVID times, and otherwise also now the IT has changed the way of doing things. and they have eased the way of doing things. So, things have become paperless. Earlier, we used to make so many multiple copies of everything. So, if I have to request inventory or stock, I have to make 5 copies of the purchase requisition form. Now it's all paperless, and the time lag has also decreased. I just, you just have to send a requisition online, and the other department, let us say the purchase department wants a raw material, or the production department wants a raw material from the stores department. Earlier they used to generate 4-5 copies. One will go to stores, one will go to this department, one will be maintained by production, one will be maintained by purchase. Or let us say the purchase department wants to purchase the raw materials. So multiple copies we have to make for a single form. Now everything has changed. We just it's all online. So the information goes to stores also, to purchase also, to production also, to vendors also. Time lag has reduced and decreased to a great extent. Efficiency has increased. So IT is commendable. I mean, things have changed. The way of doing things have changed, and it's eased out. So let us just quickly understand. Of course, more or less, all of us know what IT has done to our lives. So information technology has changed the cost and management accounting functions dramatically with the introduction of ERP, Enterprise Resource Planning. So ERP basically is, operational in most of the organizations who work under online system. Cost accounting and management information system has become automated and improved. Different functional activities get integrated, and as a consequence, a single entry into the accounting system provides custom-made reports. So just a single entry and a report is generated. So, earlier we used to make the manual reports, or cost accounting reports, different type of reports manually was being made. So one report is made by the storekeeper, that how much inventory is there, and all sorts of things. It was a very tedious and cumbersome task, and a lot of paperwork has to be done. But now a single entry, and a report will be generated. So any which way, any which report you want, it will be generated in no time. That is the power of IT. Right? So it's such an it has integrated enterprise resource planning. Basically, it has integrated all the departments. So that integration has done wonders for every organization. So single entry into the accounting system provides custom-made reports for every purpose and saves an organization from preparing different sets of documents. So documentation has reduced to a great extent. Reconciliation process of results of both cost and financial accounting system becomes simpler. Earlier, reconciliation of financial records and cost records were a cumbersome task. Okay, but now it has eased to a great extent. So because everything is integrated, everything is automated. So in no time you can have any type of reports. A move towards paperless environment, a very revolutionary change of IT in the organization. It has become paperless to a great extent. Can be seen by documents like bill of material, material requisition note. All these terms you will be understanding in the next unit, the materials. So bill of material, material requisition note, goods received note, labor utilization report, etc. no longer required to be prepared in multiple copies. Earlier, every bill, every note, every requisition has to be made in multiple copies. But now, of course, it has reduced to a certain extent. The related department can get an e-copy from the system. So now every department is integrated. Just a click of a button and you get an e-copy. So it has eased out that ways. Information technology with the help of internet basically has helping in resource procurement and mobilization also. Earlier we have to procure a raw material, we have to find a different vendors, purchase orders, we evaluate all the alternatives. It used to take a lot of time. Delay in delivery of raw material, and that could delay the production process also. But now we have to keep a stock of inventory. So if I'm piling up the stock or inventory, of course, a lot of capital also goes into it. So now with the ease of this, the time lag has reduced. So even you can purchase within no time. Earlier you have to have those, time lag of you have to keep 1 month for the delivery, or for example, if it takes a longer duration or so. But now Just-in-time inventory approach organizations want to use. Just-in-time means you want a material, you want any requirement, you just, because everything is integrated. So you just apply for that, okay, we want this material and it can come in no time. Earlier, it used to take a lot of days basically to, get the request from the department and then go to the vendor and select the vendor and everything. So now, of course, it has eased down. Each cost center cost object is codified. So every cost center, their cost object is codified. A code is attached to that. So every communication is via that code. All right. So that code is particular to that cost object only. So of course that has increased the communication to a great extent. Are assigned to the cost objects or cost centers using assigned code. So every department has a separate code, every cost object has a separate code. This automates the cost accumulation and ascertainment. So let us say code 01. So all the costs will be accumulated to code 01. So code 01, let us say it signifies product A. So we will not say product A, we will say code 01. Or this cost will go to code 01. This cost will go to code 01. So this way, the coding also helps a lot. The cost information can be customized as per the requirements. For example, when an entity manufactures or provides services, managers are able to receive information job-wise, batch-wise, process-wise, and cost center-wise. So basically, they can have information any which way. That is the importance of basically the cost accounting. It enables an entity to monitor and analyze such each process of manufacturing or service closely to eliminate non-value-added activities. Of course, the cost reduction process is a continuous process. It goes without fail, in every cost accounting department. So that is the use of IT in costing. Moving further. Installation in cost accounting system. All right. So okay. Let me just handle the queries. What is preventive? All right. Preventive is basically, let us say, safe driving. Why we always promote safe driving? So, who has asked this? Preventive. Muhammad Vora has asked what is preventive. So safe driving. Why we promote safe driving? So that we should not cause any accident. Okay, and the best example of being preventive is we are having vaccinations for COVID so that we can prevent COVID. Right? After COVID, we go for corrective. That means if we have COVID, then we go for medicines to cure ourselves. But we should not have COVID. That's why we should have vaccination. So vaccination is preventive thing. Preventive means if we have vaccination, we can prevent COVID. So again, preventive mechanism is that we should not have higher costs. So that is the cost control is a preventive mechanism. And cost reduction is a corrective mechanism. Preventive means that thing should not happen. We should be prepared beforehand only so that thing will not happen. So safe driving will prevent any accident. Prevent means it will not happen. All right, that is preventive. So what is the okay? Who fixes the selling price of products? Actually, selling price of the products are fixed by many factors. First of all, the cost is the base. The cost accounting provides the base. All right. So below this, the selling price cannot be fixed. And there are other factors. Selling price is basically fixed about the demand and the supply in the market. Right. If the higher the demand, the selling price has to increase. And if there's a huge demand in the market, the supply is huge, then you offer discounts and then the selling price goes down. So it's all about the external factors. It's more of economics rather than costing. So selling prices are fixed basically by several external and internal factors. But yes, from cost accounting department, the cost gives the base for it. All right. What is the meaning of cumbersome? Cumbersome means very difficult, cumbersome. It's very difficult, So a lot of things are happening. So it's entangled. It's very complicated. So cumbersome is that the meaning of cumbersome, right? Who fixes the selling price of the product? So they are just explained. We get the price by cost sheet. Okay, we get the price by the cost sheet, but there are other factors also that ultimately management sees when the selling price is fixed. The cost sheet, the selling price which the cost sheet gives, it's actually based on the predetermined profit rate. But there are other factors also which helps in determining the selling price by the management, the final selling price. All right. Okay. Installation of costing system. So the objective. So what are the requirements or prerequisites that the costing system should be installed? What type of costing system and what factors? It depends that what type of costing system we should install. So very quickly. The objective of setting up the costing system, for example, whether it is being introduced for fixing prices or for establishing a system of cost control. So basically, we should be understanding that this system we should have to fix the prices or for cost control. So for cost control, there has to be certain other mechanisms which should be installed in the system. All right. Nature of business or industry. So the kind of business will decide which type of costing system we should have. The industry in which the business is operating, according to its cost information requirement, cost accounting methods are followed. For example, an oil refinery maintains process-wise cost accounts to find out the cost incurred on a particular process, say a crude refinement process. So basically, it depends. Like let us say I'm a company where sugar is made. So I should have again I have to follow process accounting. Because sugar has to pass, sugar is the final product, and the sugar cane is there, then molasses is a byproduct, then bagasse is a byproduct. So, what type of organization you are in depends upon what type of costing system will be installed. So, some organization receives an order, they're based on order basis. So, a job order system has to be there. The construction company has a contract accounting system, all right? So, they basically bill for every contract. So depending upon which industry it is, organizational hierarchy. A costing system should fulfill the information requirements of different levels of management. Top management is concerned with corporate strategy, policy making, decision making. Strategic level management is concerned with marketing strategy, product diversification, product pricing. Operational level management needs information on standard quantity to be consumed, reports on idle time, etc. So what all are the requirements of the top management, middle management, operational management? Accordingly, the system will be designed. So what are the reports that the top management would require? That reports will be customized inside the system. So depending upon the requirements of the different levels of management, depending upon the requirements of a business or an industry or the type of business you want to start, cost accounting system or a costing system will be installed accordingly as per the specifications of that organization, right? Knowing the product, of course, nature of product determines the type of costing system to be implemented. The product which has byproducts, I just mentioned sugar. So molasses is a syrup, thick syrup, which is extracted when we make sugar from sugar cane. So molasses is a very, very important byproduct. So if we have a byproduct in a manufacturing process, the costing system will be requiring which accounts for byproducts as well. So depending upon the requirements of the product also. In case of perishable or short life or shelf products, marginal costing is appropriate. Marginal costing is unit costing. Every unit what the cost is added. So the continuation and minimum price at which product should be sold. So accordingly, that technique will be inbuilt in the system, depending upon what type of product you are basically starting with. Knowing the production process, a good costing system can never be established without the complete knowledge of the production process. Cost apportionment can be done on the most appropriate and scientific basis. If a cost accounting can identify degree of effort or resources consumed in a particular process. So this also includes some basic technical know-how and process peculiarity. So according to the production process, how many processes the raw material will pass. So accordingly, every process will be inbuilt. So we should know the cost of every process. So accordingly, the system will be built. Information synchronization. While drafting a costing system, information needs of various other departments should be taken into account. Which all departments you want to be integrated. All right, so that the top management wants to see the working or the cost of every department. So how and to what extent the integration is required? Which department should be kept aloof, isolated? Which all departments should be integrated? So accordingly, information needs of various other departments should be taken into account. For example, in a typical business organization, account department need to submit monthly stock statement to its lender bank. Quantity-wise stock details at the time of filing returns to tax authorities. So, what all type of information you require from the system? What all type of reports you will want? So, all those will be customized in the costing system. Moving further, maintenance of cost report. The organization must determine beforehand the manner in which cost and financial accounts should be interlocked for basically to assist reconciliation into a single integral accounting system, and how again separate sets of accounts could be reconciled by means of control accounts. Again, how much integration you require, what all should be integrated. Statutory compliance is an audit. So what all reports the statutory auditors or the government wants. So accordingly, those reports should be generated from our system. So records are to be maintained to comply with statutory requirements, and applicable cost accounting state standards should be followed. Information attributes, information generated from the costing system should possess all the attributes of useful information. It should be complete, accurate, timely, relevant to have an effective MIS, management information system. So what all statutory compliance reports we want, we should have inbuilt into our system. All right. So that is all the installation. Let me quickly. Yes, so Alok, just like when we produce buttermilk, butter is byproduct, of course. Is cost accounting only relevant to manufacturing and FMCG? No, not at all. Cost accounting is basically why only to manufacturing? If let us say I am a tour operator or I am an airline industry, is not cost relevant to me? So cost accounting is relevant to every entity, to product or to service. We want the cost of everything. If I am delivering a service, I should know what is the cost of it. Right. So, an airline company, is cost accounting not relevant to an airline company who is giving services? Is a cost not relevant to a tour operator who is just giving the services? So, it is not only to manufacturing, but yes, more important, it has to be in manufacturing, but a whole lot of cost is associated in manufacturing organization. But yes, it belongs to basically to every organization, not only to manufacturing. Right. So here we'll take a quick break of 5 to 10 minutes. All right. I'm leaving you to cost objects. So we'll just come back in 5 to 10 minutes for a short break. I'll be joining you after the break. All right, students, welcome back. So we'll be starting with cost objects now. Now the different terms we'll be understanding in this segment of the session. So cost object is basically anything for which we want the cost. All right, so it's a separate measurement of cost. The cost object may be a product. So if I want the cost for a product, I want the cost of a service which I am giving, I want the cost of a project, I want the cost of a customer. Let us say I take a customer based orders. So I want the cost of a customer. Then I want the cost of a brand or an activity, or I want the cost of a particular department. So anything for which I want the cost should be my cost object. That is my cost object. So cost object could be a product or a service or a job or a contract or a customer or anything for which I want the cost. So examples of cost objects on the screen. So for a product, a smartphone. So I want the cost of a product, a phone. So phone is a cost object. A tablet computers. For service, that cost of a flight, an airline flight from Delhi to Mumbai. So again, somebody was asking, is it applicable only for manufacturing? So see, it's applicable on service also. So the ticket from Delhi to Mumbai is actually based on the cost only. And then concurrent audit assignment. So if, let us say, per assignment, if I'm charging, per audit, if I'm charging, so my per audit, by that type of audit, a banking audit or a concurrent audit or a statutory audit. So that is my cost object. What is the cost of the banking audit? And what is the cost of a statutory audit? Utility, for any utility bill payment facility. All right, for a metro rail project, for a road project. So it can, any cost object can be there. Quality inspection of material, if we talk about activity, placing of orders, process, refinement process, what is the cost of a refinement process? So all those processes in different type of industries, department, what is the product cost of a production department, what is the cost of a finance department. So cost object could be anything for which I want the cost. All right. Next, we can move on. Cost unit. Cost unit means the unit on which the cost has to be measured. So cost should be per unit or per kg or per liter or per ton or per barrel. So the cost unit is the unit in which the cost has to be expressed or measured. So it is a unit of a product, service or time in relation to which cost may be ascertained or expressed. Cost units are usually the units of physical measurement like number, weight, area, volume, etc. So examples are given. If an automobile is there, it's like number. All right. So the cars will be like the number of cars will be the unit. Cement per ton or per bag. So this will be the cost per ton. 2,000 rupees per ton is the cost. So the measurement is in ton. The measurement is in kilogram. The measurement can be in liters. So milk packet, the cost per packet, all right? So per liter or per half liter. In cement, it's liter or gallon or kg or ton. Power, kilowatt hours, how much kilowatt hours you have used. Steel, again, ton. Transport, passenger, kilometer. Gas, cubic feet. So all these are just some examples of what are all the units that can be used for ascertaining the cost or expressing the cost. Cost driver. Let me just see the queries if anything. What means what student has asked, what means by resource procurement and mobilization. See, resource procurement is fetching the resources or buying the resources. We want to purchase the resource. Mobilization is basically what we are purchasing from the market, for example. So resource mobilization is procuring the resource. Procuring means getting or purchasing the resource, the right type of resource at the right time, at the right price, and to have it optimally used. That is resource mobilization. Just purchasing is not resource mobilization. We are just purchasing the resource. But what is resource mobilization? You are not wasting it. You are getting the right type of resource from the right person at the right time when you require it, at the right price. And then you are optimally using it without wasting it. How much you want, exactly that much you have purchased. All right. So overstocking should not be there. That is the whole concept of resource mobilization. So very important question you have asked. So moving to the slide now, cost driver. See, cost driver is a concept basically is a factor or variable which affect the level of cost. So cost driver is something because of that the cost is being incurred. So cost driver is that activity which due to which the cost has arisen. For example, if I'm using the electricity, because I'm using the electricity bill is coming. Here, so the cost driver for that electricity bill is my consumption of electricity. Yeah. So cost driver is what activity, what is being done due to which the cost is incurred. I'm using the electricity, consuming the electricity. That's why electricity bill has come. So cost driver is the activity, that is the consumption of electricity. So cost driver is something is happening somewhere, because of that, the cost is arising in any department. So what all activities are getting done in that department due to which the cost is there. Yeah, so that is the whole idea of cost driver. A cost driver is a factor or a variable which affects the level of cost. So if I increase the consumption of electricity, the electricity bill will increase. So cost driver has a direct cause and effect relationship. Higher will be the consumption, higher will be the bill. So if cause and effect relationship is there, because of that cause, my electricity bill is coming. So cost driver always have that cause and effect relationship. Generally, it is an activity which is responsible for cost incurrence. Because of that activity, cost is incurred. All right. An activity may be an event, task, unit of work. So example of cost drivers are number of machine setups. That's why, machine cost is being incurred. Number of purchase orders, hours spent on product inspection. So if I've spent 50 hours on product inspection, I am taking 500 per hour. So the number of hours I'll be spending, my cost of whatever I'm getting, the bill will increase. So the cost driver is the hours I am spending. What activities somebody is doing so that because of that cost is being incurred. Number of tests performed, etc. All right. So cost driver is the reason. That's why the cost is there. Now responsibility centers. So basically, I've explained you earlier occasions also. Responsibility centers are basically the centers which are handled by some manager or a head of that center. So we'll have a better understanding. To have a better control of the organization, management delegate its responsibility and authority to various departments or persons. See, a single person cannot handle all the departments. So when the organization expands, it has to be decentralized. It has to be managed by now different persons. A single person cannot manage all the departments. When an organization is small, then of course one person can handle. But when the organization is growing, it's getting big, then you have to have certain other managers also who will handle the different departments. So all those are responsible. They are responsible for the departments. That's why it's called responsible centers. So these departments or persons are known as responsible centers, responsibility centers, and are held responsible for performance in terms of expenditure, revenue, profitability, and return on investment. So for that particular their center, they are responsible for that, for everything that is happening in that center. That's why it's called responsibility center. Performance of these responsibility centers are measured against some set standards, input and output or budgets, and evaluated against organizational goals and performance targets. So their performance will be evaluated against, of course, some standards must have kept by the management that you have to, these are your performance standards. The cost should not be more than this. The revenue, you should achieve the revenue target of this much. So they have their own performance standards. So different responsibility centers are cost centers, revenue centers, profit centers, and investment centers. Cost centers, they are responsible just for the cost. So cost center will not have any selling activities, right? So cost centers, which are in their control, the performance of this responsibility center is measured against predetermined standards or budgets. The cost centers are of two types, standard cost center and discretionary cost center. Standard cost center is basically for which the inputs are specified and the outputs can be measured. So standard cost means if this much is raw material, so this much has to be the output. All right. So if 200 units are the raw material, so 1000 units of output should be produced. So standard cost center means everything can be measured, everything can be specified. They have to have a cost and effect relationship. All right. And that we can measure. That is standard cost center. Discretionary cost center,
we cannot measure the cause and effect relationship. We cannot, something which is happening, we cannot, what is the output? So we cannot measure the input and with the output. In standard cost center, we can measure the input with the output, but in discretionary cost center, we cannot measure it. For example, the best example of discretionary cost center could be research and development or advertisements. So let us say the management says 5 lakh will be spent on advertisement. Can you measure how much that 5 lakh has actually increased the output of that company? We cannot measure. But yes, we can measure if 100 units of raw material are introduced. So the ratio should be 1000 units of finished product. So we can measure. But discretionary cost center, we cannot measure the input and the output. So if I spend 5 lakh on advertisement, if the management said, okay, spend 5 lakh on advertisement, we cannot measure how much is that 5 lakh contributed to the output of the organization. So that is discretionary cost center. The cause and effect cannot be measured. Revenue cost center, the responsibility which are accountable for generation of revenue. So sales department is the best example for revenue cost center. In a revenue center, there are selling activities. So revenue centers generate revenue for the organization. Cost centers only generate costs. There is no revenue in the cost center. So purchase department, production department, inventory department are generally cost centers. They only generate costs. But revenue center, sales department generate majorly they generate revenue. The sales is generated from sales department. So that is a revenue center. Profit centers, some profit centers means these responsibility centers generate cost also and revenue also. So the best example is any branch. So let us say any branch of an organization, the head office is in Mumbai and the branch is in Noida. So the branch is taking care of cost also and revenue also. So and any center which takes care of cost and revenue both is a profit center. So they have their own profit, the branch profit. So that is a profit center. There are responsibility centers which have both responsibility of generating revenue also and they can incur expenditure also. Alright. So since managers of profit centers are accountable for both cost and revenue, profitability is the basis for measurement of performance of these centers. So how much profit they are basically generating. So that way their performances are measured. Investment centers are those responsible centers who have the cost also, the revenue also, and they invest also. Right? So since they are investing, so they are responsible how much return on investment they are generating for the organization. So those are investment centers. So they have the authority to make capital investment also. So when I was talking about branches generally don't make capital investment. They just generate the profit. Capital investment is done by head offices only. But there are certain investment centers, they generate the profit and also they have the authority to capital invest also. Right? The performance of these responsible centers are measured on this ROI, how much return on the investment they have generated. So all sorts of investment centers, Maharatna, Navratna, Vidiratna companies of India, the public sector, I hope you know, all ONGC, NTPC, GAIL, BPCL, HPCL, they are all called the Navratna companies. They are under the public sector. So they make investments also, right? So they are the profit centers and the responsibility centers and investment centers. Okay, so now we have come to a very, very important segment, which is cost. So now you will be understanding. So here we are going for the cost accounting part. So you should understand the different characteristics of cost. Very interesting part. So that it's going to help you basically in the cost accounting part. Any this? Okay, cost driver को हिंदी में बता दो. Okay. See, cost driver is something उसकी वजह से जो है आपकी कॉस्ट क्रिएट होती है. ठीक है. जितनी आप इलेक्ट्रिसिटी, जैसे मैंने इलेक्ट्रिसिटी का एग्जांपल दिया, who has asked Jyoti. So Jyoti has asked the cost driver. I should explain in Hindi, although I prefer the English medium, the English conversation. But again, very quickly I can explain in Hindi also. मैंने इलेक्ट्रिसिटी का एग्जांपल दिया था. तो जितनी आप इलेक्ट्रिसिटी कंज्यूम कर रहे हो, आप जो इलेक्ट्रिसिटी यूज करते हो तभी आपका इलेक्ट्रिसिटी का बिल आता है. तो एक्टिविटी क्या हो रही है? इलेक्ट्रिसिटी कंज्यूम करना. तो जो भी आप काम कर रहे हो उसकी वजह से अगर आपकी कॉस्ट आ रही है, तो जो आप काम कर रहे हो वो कॉस्ट ड्राइवर है, ठीक है। कॉस्ट ड्राइवर मतलब जो ड्राइव कर रहा है कॉस्ट, जिसकी वजह से कॉस्ट क्रिएट हो रही है। अगर आप इलेक्ट्रिसिटी यूज नहीं करोगे तो बिल नहीं आएगा, है ना। और अगर आप जितना ज्यादा करोगे उतना ज्यादा बिल आएगा। तो आपका वो काम करना, इलेक्ट्रिसिटी कंज्यूम करना कॉस्ट ड्राइवर कहा जाता है। जितना आप ज्यादा करोगे उतना ज्यादा बिल आएगा, उतनी ज्यादा कॉस्ट आएगी। कम कर दोगे तो कम कॉस्ट आएगी, नहीं करोगे तो नहीं आएगी। तो किसकी वजह से कॉस्ट कम हो रही है, बढ़ रही है, नहीं आ रही है? आपकी कंज्यूम करने, जितना आप यूज कर रहे हो। तो आपका इलेक्ट्रिसिटी को यूज करना कॉस्ट ड्राइवर है, जो कॉस्ट को ड्राइव कर रहा है, जो कॉस्ट को कंट्रोल कर रहा है ना। आप एक तरह से वो रिमोट कंट्रोल है। आप बढ़ा रहे हो कंजम्पशन तो कॉस्ट बढ़ रही है, आप कम कर रहे हो तो आपके हाथ में रिमोट कंट्रोल है ना, आप यूज कर रहे हो। तो आप कॉस्ट आपके हाथ में, जो आप जिस तरह आप यूज कर रहे हो उसको कॉस्ट ड्राइवर बोला जाता है, ठीक है। तो ज्योति, आई होप आपको समझ आ गया होगा। All right. ROI, return on investment. See, return on investment और return on capital employed, of course, दोनों सेम है। रिटर्न ऑन इन्वेस्टमेंट होता है, अगर आप फाइनेंशियल अकाउंटिंग में समझते हो तो ROI और ROCE, रिटर्न ऑन इन्वेस्टमेंट, फाइनेंशियल कंसेप्ट है, बहुत ज्यादा इसमें नहीं जाएंगे, कॉस्टिंग पे फोकस करेंगे। बट रिटर्न ऑन इन्वेस्टमेंट इज how much investment you are doing. So basically, I'm referring to the asset side of the balance sheet. And when I'm referring to return on capital employed, I'm referring to the liability side. How much capital I've employed. Capital means the capital, the loan, the long-term borrowings. So return on capital employed or return on investment, meaning the same. One is on the asset, focus on the investment or the asset. Other is the focus on the capital employed or the liabilities. All right. So moving further with the cost. So there is this classification of cost, element wise. We are focusing on element wise first. All right. So direct material, direct labor, direct expenses. Direct material is something which we can identify in the product. Let us say there is a pen. So if there is a pen, it's the pen. So pen में आप सबसे ज़्यादा क्या देख सकते हो? You can see the raw material. All right. So raw material is visible in the pen. So something which is identified in the product, it is present in this product. All right, and you can identify that it is present in the product, the raw material. That is the direct material. Direct material is something which is visible in the product. You can identify that it is in the product. It is directly used in the product. That is direct material. In some cases, material may be direct, but it is treated as indirect because sometimes very, very small amount of material is used in every product. So that small amount of material we treat it as indirect only, because we cannot do the direct costing of that small amount of, we should always focus on the significant, the important amount, the important part of the cost. Direct labor is which, again, the labor which can be identified directly on a cost object. So this object, I can identify that, okay, 5 laborers must have worked on the products. So who have, the laborers who have worked on the product is my direct labor. All right. Employee engaged on the actual production of the product or carrying out the necessary operations for converting the raw material into finished product. So the laborers who are actually working in the manufacture of the product. For example, the pen, from the raw material, from the plastic to the pen, who the laborers are actually working on them are the direct laborers. Direct expenses means, again, the expenses which can be directly related to the product. So special machinery has taken on rent for manufacturing all these products. So that special machinery, the rent I'm paying for that machinery is my direct expense. So direct material, direct labor, direct expense are all these 3 elements which are visible or identified on a product. All right, they can be identified. That is the direct material, direct labor, direct expense. They are direct cost. So direct material, direct labor, direct expense makes the direct cost of a product. All right, and they are generally variable. Variable means they change with the production. All right, we'll be doing the fixed and variable related things. Indirect material, indirect labor, indirect expense. So indirect material means which are used, but they are not directly visible on the product, but otherwise they are used. All right. So let us say if any, these are stores used for maintaining machines and buildings and lubricants and everything. So materials which are used for the production as a whole, but not visible on this product, are indirect material. Indirect labor, the laborers, the foremen, the supervisors who are working in the factory area only, but they are not directly working on the product. They are facilitating the manufacture. They are facilitating the whole production process. They are also part of the whole game. But yes, they are not directly working on the product. That's called indirect labor. Indirect expenses, all sort of expenses which are incurred, but not directly on the product. But yes, they assist, they facilitate. They are part of the total cost of the manufacture. Not exactly on the product, but otherwise. There are many expenses which have to be incurred because of the manufacturing. So that are indirect expenses. So indirect material, indirect labor, and indirect expenses are called as overheads. All right. I'm repeating. Direct material, direct labor, direct expenses. Something which can be visible on the product are called direct cost. Indirect material, indirect labor, indirect expenses, which are not directly visible on the product, but they are incurred for the production only. All right. They are called overheads or indirect cost. Moving further. So I just said the aggregate of indirect material, indirect labor, and indirect expenses are termed as overheads. Production of works overhead, administration overhead. So there are different heads which have been basically, they have classified them. So production, indirect material, indirect labor, indirect expenses happens in the factory area also. It happens in the office area also. It happens in the sales department also. So everywhere we can classify it. So there are basically 4 types of overheads. Production overheads basically deals with all the indirect costs in the factory area. Administration overheads deal with all indirect costs in the office area. Selling distribution are basically all the indirect expenses which relate to the sales. So advertisement, anything which directly helping the sales or promoting the sales are called selling expense or selling overheads. The moment we say overhead, it means indirect. All right. So overhead is another meaning for indirect. Distribution, anything which is related to dispatch or logistics of the goods. Logistics means the transportation of the goods for sale and everything from warehouses, packing, loading, unloading. They are called distribution. So overheads are classified into production, indirect, factory. Production means indirect factory expenses. Admin means indirect office expenses. Selling means indirect sales expenses. Distribution means indirect logistics and dispatch and everything, all those things. So overhead actually means indirect. So overheads have been classified into 4 categories. Office, factory overheads, office overheads, administration overheads, selling overheads, distribution overheads. So this way it goes. Right? Functions. So by functions again, see the elements are the same. Direct material, direct labor, direct expenses are called direct cost. And direct cost, the other meaning is called prime cost, as you can see. So prime cost is nothing but direct cost. Direct cost is nothing but direct material, direct labor, direct expenses. All right. To the prime cost, if we add, now I told you there are basically 3 to 4 types of overheads: factory, admin, selling, and distribution. If we add factory overheads to the prime cost, we get the factory cost or the works cost. To the factory cost or works cost, if we add admin overhead, admin means office and administration, we get cost of goods sold. When we add selling and distribution to cost of goods sold, we get cost of sales. We will be doing this in the cost sheet, I think in the next unit. So this will be done in detail. All right. Here it is just a classification of cost, but you will be doing questions on this format, which is called the cost sheet, right, in the next unit. So here you just try to understand that prime cost is nothing but direct cost. And after prime cost, all the 3 overheads start. After prime cost, we add factory overheads to the prime cost. So we get factory cost. To factory cost, we get administration overhead, we get cost of goods sold. To cost of goods sold, we add selling and distribution, we get cost of sales. All right. Moving further. So variability of behavior, fixed cost, variable cost, and semi-variable cost. Fixed cost basically is the cost which is incurred for a period. Fixed cost will not change with the production units. You are basically not producing anything, like during COVID times, the factories, there was no production going on. But if you are giving if you have taken a factory on rent, you have to pay the rent. So fixed cost does not change with the production. You have to pay fixed cost. Variable cost, you change with the production. And remember, prime cost or the direct costs, direct material, direct labor, direct expenses are always variable. All right. If you will manufacture a pen, only then direct cost will be incurred. Raw material will be incurred only when you manufacture a pen. But the rent of the factory you have to pay, irrespective you make this pen or not. Right? So fixed cost is irrespective of whether you are producing or not, you have to incur fixed cost. Variable cost will happen only if you are producing. You are doing production. Semi-variable is basically some part is fixed and the balance is variable. The best example of semi-variable could be again the electricity bill example. So if you know about the electricity bill, have some knowledge about electricity bill, you must be knowing that till certain units, the electricity bill is fixed. Let us say if till 500 units of consumption, the electricity bill will be 5,000. Till 500 units. If you move beyond 500, then the electricity bill will increase. So let us say you are not consuming electricity. Your house is closed for 2 months. Still you have to pay minimum 5,000. So that is the fixed component. But if you increase your consumption beyond 500, especially in summers, ACs are working and everything. So the electricity bill is huge during summers. So if you are consuming electricity beyond 500 units, then your consumption will increase accordingly. So till 500 units, your electricity bill is fixed for rupees 5,000. Beyond 500 units, it becomes variable. So semi-variable means it has the component of both fixed and variable. All right. So fixed cost, variable cost, and semi-variable cost. Fixed cost does not change with production. Variable cost changes with production. Semi-variable has fixed and variable components both. All right. Yes. Okay. Clear ho gaya, ma'am. We can say direct material is the basic structure of fixed good, finished good. Yes, of course. Direct material is, see, for any product, direct material is the major cost part. All right. Sum of direct material, prime cost, indirect material, overheads. Yes, very good. So sum of the direct cost is the prime cost, and sum of indirect are overheads. Very, very, very good. Salary to supervisor is indirect labor. Yes, of course. Salary to supervisor, you cannot measure how much time supervisor has given on this product. So salary to supervisor is indirect labor, right? Okay. Good. So we are moving forward. Semi-variable costs. So there are certain methods which you can just learn how to segregate semi. So semi-variable means partly is fixed and partly is variable. So how to disintegrate it? All right. So there are certain methods. Quickly we can just do. Graphical method is basically, if you can see, on the x-axis there is output. On the y-axis there are semi-variable overheads. So if I can explain you this. Here, this is output line and these are semi-variable overhead line. So randomly, I have put the dots over here. So semi-variable overhead, that means the dots are the semi-variable overheads under different options. All right. So different semi-variable overheads are there. And then there's a best fit line is being drawn. So this is the best fit line. What all cost it will cover, and rest it will leave. So the cost which is going above and below the best fit line are basically can be seen as abnormal cost. So the best fit line will be drawn, and the line which intersects the y-axis. This is the y-axis and this is the x-axis. So the best fit line, the intersect point, basically it is the fixed cost. All right. So line is drawn parallel to the x-axis. This is fixed cost. And the difference between the line and the fixed cost line is the variable cost part. All right. So this is the semi-variable graphical method. So different options of semi-variable line is drawn, and we have joined the best fit line, joining all the options, all the alternatives of the semi-variable overheads. And then the point at which it intersects the y-axis is the fixed overhead line drawn parallel to the x. Difference between fixed overhead and the line is the variable overhead. So this is a graphical method basically on an estimate basis, right? Moving further, the high-low method. High-low method is nothing if you can see the sales value, the highest sales and the lowest sales, the highest cost and the this there. So this cost is basically semi-variable cost. We have to disintegrate into fixed cost and variable cost. So how to disintegrate? The total cost is given. So what we are going to do is high and low method. So that means that we have found out the difference between the high sales and the high and low cost. So difference between the two. The difference between high sales and low sales, the difference between high cost and the lowest cost. So 12,000 divided by 60,000. Cost divided by sales value. Alright, cost divided by sales value. So that means the variable cost is 20% of sales value. The variable cost proportion has come 20% of sales value. 20% of sales value means 140,000 into 20% and 80,000 into 20%. So 140,000 into 20% is 28,000. So this is the variable cost. So if I deduct variable cost from the total cost, I get the fixed cost, right? So what we have done? We have first taken the difference between the high and low sales and the high and the lowest cost. Then we have divided the high and the lows of the cost and the sales value, the difference. Total cost divided by total sales, we get the proportion of variable cost. So variable cost comes 20% of sales. That means 20% of 140 and 20% of 80 will be the variable cost proportion. So 28,000 if the variable cost is there, total cost is 72. So the difference has to be fixed cost. Similarly, we can see the lowest. 80,000 is the sale, 20% is the variable proportion. So that means 60,000 is the variable cost out of this 80,000 into 20%. 16,000 is the variable cost out of 60,000. So if I take out 16,000 from 60,000, 44,000 again. See, fixed cost remains same. So fixed cost under both the alternatives, whether the highest sales, lowest sales, highest cost, lowest cost, fixed cost remains the same, and that is the property of the fixed cost. Variable cost changes. At the highest volume, variable cost is 28. At the lowest, variable cost is 16. Which cost is increasing or decreasing? Variable cost. Fixed cost remains the same. So that is one method to segregate between the variable and the fixed cost. All right. Moving further, the third method. So here we have taken just the difference between expense and output. In the previous slide, we have taken the difference between cost and sales. Here we have taken the difference between expense and output, semi-variable expense. Again, it has both fixed and variable, and we have to segregate. So difference between the difference between the highest and the lowest, or the difference between months also you can take. So expense divided by production. Expense divided by production, or the output, the quantity. So the variable cost will be 1 per unit. 40 divided by 40. So 1 per unit is the variable cost. Alright. So 1 per unit is the variable cost. Unit is this. So 100 units into 1 variable cost per unit. So variable cost will be 100. So if 100 is variable cost, out of 260, 160 has to be fixed cost. Here. So similarly, if I calculate the same for February also, units are 140, variable cost is 1 per unit. So the variable cost will be 140. 140 is variable cost out of 300. So 160 has to be fixed cost. So see, fixed cost remains the same. 160 in January and 160 in February. Fixed cost will not change with the change in the output, but variable cost change. So for January, the variable cost is 100. For February, the variable cost is 140 because it's 1 per unit. So variable cost is 1 per unit. All right. So this is another way. In earlier example, we basically took the difference between sales and the cost. Here, it's the units and the cost. All right. Next method is the equation method, which is the least square method. So least square method, it has this equation y equal to mx plus c. Y is the variable cost. All right, y is the semi-variable cost which we have to disintegrate. So semi-variable cost is the total cost. M is your basically the variable cost. So M we don't know. X is the number of units. Volume of output means number of units. And C is the fixed cost, right? So we don't know M, we don't know C. We know Y. We know the total cost. But we don't know how much is variable and how much is fixed. M is variable and C is fixed. We don't know the breakup. We know the total Y. So Y is the total cost. X is the volume of output because variable cost changes with output. Yeah. So we have just placed the equation. 1200 is my total cost in equation 1 for this level of activity. And 1275 is my total variable or total semi-variable cost. So 1200 we have to disintegrate and 1275 we have to disintegrate between fixed and variable. 150 are the number of units. 150 C labor hours or the units. From where we have to calculate the cost basically. It could be units or it could be hours. So 150 and 200 are the hours. M we don't know, C we don't know. So solving the equation, the variable cost comes to 1.50 per hour. If you know how to solve it, minus. This is the way it is done, right? So it will cut and now you can calculate. So basically it will be 75 is equal to 50 M. So if you calculate, M will be 1.50 per labor hour. That means 1.5. So if M is 1.5, I think you can calculate. So you will get C. Yeah. So just you can calculate the value and this way you will get the variable cost separately and C you will get also the fixed cost. All right. So this is the way the least square method is being used. So you can practice it also. Okay, now there's another the category of cost which is called under controllability. So some are controllable costs, some are uncontrollable costs. Now, controllable costs are those which the manager is responsible for their responsibility center. So, the manager inside the responsibility center can control the cost. But there are certain uncontrollable costs which nobody can control. Let us say if every department will get the share of electricity bill or the telephone bill, or let us say the canteen charges, they are not controllable. So within the department, the manager can control the cost. So those are controllable costs. Uncontrollable cost is which every department will share. But nobody can control that cost. Only they will get their share of the cost. So that is the whole concept of controllable and uncontrollable. So cost that can be controlled typically by a cost, profit or investment center. That means costs which can be controlled by or within a responsibility center are called controllable costs. Uncontrollable, which cannot be influenced by the action of a specified member of an undertaking. So it's an individual manager cannot control it. Right? Those are uncontrollable. Let us say expenditure incurred on tool room sharing expense, or as I said, the security expense will be shared by every department, or the canteen expense will be shared by every department. So those costs you cannot control because you're just getting a share of them. You have to, share the cost of those services. That you cannot control. But any cost which is happening in your department, in your responsibility center, that you can control. So all about controllability and uncontrollability. Normal cost, abnormal cost. So normal cost is whatever happens during the normal course of manufacture is a normal cost. Abnormal cost is something which never happens in ordinary course of manufacture or ordinary course of business. Let us say, there is a breakdown of a machinery and the machinery could not be used for 2 days. That's an abnormal cost. But every day, if half an hour machinery has to give rest to, that is a normal cost, all right? So all those material and labor and other expenses which happen on a day-to-day basis are the normal costs. Any event which generally don't happen. So the strikes and the lockouts or whatever, any fights or tussle or any abnormal breakdown of machinery or anything that happening which is not happening in the ordinary course is the abnormal cost. All right. Okay, so costs which are used in managerial decision making. Predetermined costs, so we have actually discussed more or less here and there all these types of costs. So very quickly we can share any queries if you may have. Okay, no, capacity of percentage is not used in lead scale method. Its capacity is just that we have given the two cases. Could be the capacity, or could be the products, or could be the months, or could be the 2 quarters. It could be anything. So don't get confused with that capacity percentage. It's just that we have to give two categories. Could be of 2 products or 2 months or 2 quarters or anything. Okay? So that capacity percentage has nothing to do with least square method. Alright. You can use the method any which way, but it's the simplest way to use it. So why to complicate it? All right. Otherwise, you can use it in your own ways. The fixed and variable cost should be the same in any which method you may like to use. All right. Uncontrollable and abnormal cost. I just gave example of many examples I gave for abnormal cost and uncontrollable cost. All right. So cost in managerial decision making, predetermined cost we have already discussed. Predetermined cost is basically which we predict based on the past experiences, specification of factors. Standard cost is the predetermined cost which the management wants a standard. Let us say I have 3 predetermined costs, that rupees 500, rupees 450, rupees 400. So there might be the scenario of 3 predetermined costs. Management wants, okay, the predetermined cost of 400 should be kept as a standard. So predetermined cost becomes the standard cost depending upon the basically what the management expected standards are or what management policies are. So standard cost is basically the finalization of predetermined cost. Marginal cost is basically the increase or decrease in the cost by increase or decrease of 1 additional unit of production. So if I have produced 1000 units, the cost is 500. If I have produced 101 units, then the cost is 550. So marginal cost is the extra cost which I have to incur because I have increased the production by 1 unit. So by 1 unit, the cost increased by rupees 50. So 50 is the marginal cost. The marginal cost is increased or decreased by 1 unit. That is marginal cost. Estimated cost, again, the cost, it's all used interchangeably. Predetermined, standard, estimated cost is all about the prospective cost on basis of the past experiences. Differential cost. So differential cost is always when, let us say, differential cost would be like I have to get additional order. So for that additional order, I have to make an additional factory setup. So my cost will increase. So differential cost means the existing cost and the future cost, which is going to increase or decrease whatsoever due to, let us say, the additional orders or the additional technology or whatever. So whatever, and the difference between present scenario and the future scenario. And if I'm using the future scenario, could be additional product or additional order or a better technology. What is the difference between the costs? Whether it is increasing or decreasing, that is called the differential cost. All right. Imputed cost is also called the notional cost. All right, or the implied cost or implicit cost. They all are used interchangeably. Imputed cost is the cost which is not actually incurred, which is a notional cost. All right. So if I am, which basically is only for the to understanding, there is no cash outflow, there is no cash outlay in imputed cost. So if we can read, these costs are notional costs which do not involve any cash outlay. Interest on capital, payment which is not made is imputed cost. These are actually similar to opportunity costs. So if I am not investing in a bank, I want to invest in a bank and I'm not invested in a bank, so I have lost the interest which I might get. I have invested that money in the business. So the imputed cost, the notional cost, the opportunity costs are all similar concepts. They are the concepts which that means that cost there was no outflow of those costs. All right. So that is an imputed cost, just a notional cost. I have invested capital in my business. I will not get interest. I'm not taking interest on capital from my business. That is a cost, but business has actually not paying me interest. So that's a notional cost, all right? Capitalized cost means, let us say I have bought a machinery and I have paid on installation of machinery, or I have paid on commissioning of machinery. So anything which at the time of purchase, that installation expense has to be added to machinery. If you know the financial accounting also, we capitalize the installation expense of machinery to machinery account. So capitalized cost means which otherwise they are revenue expense, but initially they are capitalized or they are added to the main cost. After that, they are treated as a revenue cost only. All right. So these costs which initially recorded as asset. So installation cost is also part of the machinery cost initially. After that, when machinery is put to use, then any cost will not be capitalized. But initial every cost which is incurred on machinery has to be capitalized. That means it has to be added to the cost of the machine or the asset, whatever asset. I'm just taking an example of machine. So it has to be added to the cost of the asset. Product cost, any cost associated for the product, for the manufacture of the product will be the product cost. So direct material, direct labor, direct expenses, direct cost, prime cost, product cost are all the same. All right. So generally, product cost has also some non-manufacturing also, but mainly product costs are direct costs. So if you can see, these costs are associated with the purchase and sale of goods. In the production scenario, if we talk about acquisition and conversion of materials, manufacturing inputs into finished product is also all called the basically the product cost. So what all forms part of the cost of the product is called the product cost. Anything which is related for the product, which is incurred for the product, of course direct cost and some chunk of the indirect cost makes the total cost of the product is called the product cost. Here. Opportunity cost, we just, it's an economics concept also, and it's a concept which is applicable in every discipline actually. Opportunity cost is the value of the, sacrifice or the value foregone because we have invested somewhere else. I gave the example of investment in bank. Suppose I want to invest 10,000 in bank, and from that 10,000, I will get some interest of 1,000. But I have not invested in bank, I have not deposited in bank, I have invested 10,000 in business. So that 10,000 interest which I have sacrificed because I have invested in my business, that 10,000 interest which I have lost is the opportunity cost. It's basically the benefit foregone because I have invested in an alternative course of action. That is opportunity cost. All right. So for everything what we do, we have foregone some benefit elsewhere. So one benefit we have foregone because we have invested somewhere else. That is opportunity cost. All right. Out of pocket cost, basically, it involves cash outflow. Out of pocket cost is basically, let us say, if I give a general example, like we have to, take the clients on a lunch so that any business dealing should be finalized. So out of pocket cost is actually when something happens, then only it will happen. If that business deal will not happen, suppose. So then, or I can give another example as for cost accounting. If I have to buy a machine and I have to give an old machine in replacement, so my out-of-pocket cost might not happen also. All right. So the machine is, let us say, the new machine costs rupees 5 lakh. The old machine which I am giving in exchange costs rupees 4 lakh. So the balance 1 lakh is my out-of-pocket cost. That means out of 5 lakh, 4 lakh I never had to pay because I exchanged that old machinery in exchange for that. And the balance only I am paying. So the balance which I am paying is my out-of-pocket cost for the purchase of an asset. I think that's an example which you must have understood for out-of-pocket cost. Shutdown cost. Shutdown cost means basically the fixed cost. That means if I am temporarily shut down my company or my business or my factory, what the temporary cost which I have to still incur. Best example is rent of the factory. If my factory is closing down temporarily, let us say during COVID times, the factories were shut down, but everyone was paying the rent of the factory. So shutdown cost means even if your business is temporarily shut down, you still have to bear the cost. That is shutdown cost. Right? Moving further. Yes, salary of proprietor is notional cost, opportunity cost, next burst alternative, very good. Imputed cost and opportunity cost. See, there is actually not much difference. Imputed cost is could be any basically any notional cost, all right? But opportunity cost is always a benefit foregone. Right? Imputed cost is not always benefit foregone. Imputed cost can be any notional cost, which might not happen. All right. So that is the imputed cost or the notional cost. Sunk cost. Sunk cost means the basically the costs which are not relevant for decision making. Sunk cost means the past cost which you have incurred. All right, which has now no bearing on my next decision. If I have spent 1 lakh on advertisement, now that 1 lakh has gone. It will have no effect on my future decision making. So if I have to take another decision, which the 1 lakh which I have spent on my advertisement is basically sunk cost. It has now no carry forward of any cause and effect. It's gone. It's done now. All right, that is the sunk cost. Absolute cost. Absolute cost means, let us say, if we are finding the cost of any product, I'm finding the absolute cost. I want the absolute material cost, absolute labor cost. So absolute cost means whatever we make the cost sheet, whatever we make the format of the cost, absolute cost is always in absolute terms. So could be absolute total or absolute unit cost. So basically, it always whatever the different variables of cost we have incurred. Discretionary cost. Again, I've explained you earlier also, discretionary cost does not have that cause and effect relationship. It does not have that input-output relationship. So discretionary cost is, they are not tied to a clear cause and effect. All right. So the best example is advertising or public relations. I spent 5 lakh on advertisement. Can I compare? Can I measure? How much is that 5 lakh actually led to my output or to my sales? I cannot measure. So discretionary cost is which the management has taken decision out of its own will that, okay, spend 5 lakh on research and development. Can we compare or can we measure how much that 5 lakh or 10 lakh of research and development or advertisement has contributed to my sales? We cannot measure. So that is a discretionary cost, all right? Where they don't have a clear-cut cause and effect relationship or input-output relationship. Period costs, again, they are so-called fixed costs. They are not product costs. They will, irrespective of product, they have to be incurred, all right? So all those general administrative expenses, the salaries, which basically depend upon time period, all right? Monthly or annually or fortnightly or weekly, anything we are paying as per time, not as product or manufacture output or production. That is the period cost, all right? Engineered costs are basically those costs which have a clear cause and effect relationship. So all my direct costs, like if I'm purchasing 100 units of raw material, it should manufacture 1000 units of finished output. So engineered cost is, that's the difference between engineered and discretionary cost. Discretionary cost, we cannot have clear-cut input-output relationship. But engineered cost, we can have cleared input-output relationship. This is the input and this should be the output. Right? Those are engineered costs. Expletive costs are those, again, out-of-pocket costs, which refers to cost involving immediate payment of cash. So expletive cost, every cost is expletive cost. Every cost where there is cash payment, later or now, whenever. If there is any cash payment, those are explicit costs. Implicit costs, again, do not have any immediate cash payment. They are not recorded in the books of account. They are called economic costs. So again, all those notional costs and everything, they are basically called the implicit cost. Moving further, so this is an exercise. I think you can just practice later on also. It's just about which costs are direct, which are indirect. So it's an exercise of healthcare facility. So if you can a direct or indirect cost with respect to each patient. So electronic monitoring has to be for each patient. So it's a direct cost. Remember, direct costs are always variable, right? Meals for patient per patient. It's a direct cost, a variable cost. Nurses' salary has nothing to do with how many patients the hospital has. So nurses' salaries is my fixed cost or indirect cost. Parking maintenance has nothing to do with how many patients will be admitted or how many patients are there in a particular day. So again, it's indirect cost. Security again has nothing to do with the number of patients, so indirect cost. So electronic monitoring has to be for per patient, mails for patient has to be for per patient, and rest of the three are indirect. So just a quick exercise I just have included. Moving further, methods of costing. Can we just explicit? Okay, you have learned all costs in CA Foundation. Okay, good to know. Yes, explicit costs are also known as accounting costs. Yes, explicit costs are known as accounting costs. So all accounting costs which have a cash outflow, which are recorded, are all called. So explicit costs definitely are accounting costs. Okay. Okay. So method of costing, single or output costing. Now this is basically how we have to do the methods of costing. Accordingly, we develop a costing system. So single or output costing, let us say per product or per unit is my output or single costing. Single costing means per unit. All right. Per car. So car is my output costing per car. Batch costing is so lot of many lots in one batch. So let us say medicine. Medicine is a good example of batch costing. If you have purchased medicine, if you have just identified somewhere, if you have focused that when we make the chemist makes the medical bill, he always writes the batch number. So medicines are always manufactured in batches. So let us say 100 strips of, let us say 1 crocin strip. It has 10 tablets. So 10 strips in one batch will be manufactured. So batch costing happens in pharmaceuticals most of the time. That means many lots of the product in one batch. So let us say 100 units in one batch. So 100 units will have one batch number. Yeah. So batch costing is when many small units are produced in one lot or one batch. So their identification is their batch number. Yeah. Job costing is basically when we get the cost for a particular job. All right. So that is job costing. Could be the customer order. So I have received one customer order for that particular job. Let us say I have got the order for printing 1,000 invitation cards. So 1,000 invitation cards is my one job order. I have got one job. So the cost of 1,000 invitation cards will be, let us say, 5,000, and I have asked for rupees 10,000. So the cost will be ascertained for one particular job. I will tell to my client that, okay, 1,000 invitation cards, the cost will be 10,000. So I have ascertained the cost for per job. So again, in one job, many units of a product can be there. Yeah. So per job means per order, per customer order, or anything. Contract costing is basically under construction business. So per contract, let us say the government has given the contract for construction of road, or a construction of building, or a construction of highway, or a construction of underpass. So it's basically relevant for a construction contract. So construction companies, you will be doing, see, every method of costing is a separate unit in your cost and management accounting. You will be studying these in detail. All right. So single and product costing, batch costing is a separate unit, job costing is a separate unit, contract costing is a separate unit. So how the cost costing, how the cost accounting is done, how the cost ascertainment is done, how the cost is accumulated, you will learn in detail in separate units. So every method of costing is a separate unit in your course to learn. All right. Process costing, like I took the example of sugar. So when the sugar manufacturer starts with sugar cane, then the first byproduct is molasses or bagasse. So it's a process costing, right? So we have to understand and accumulate the cost of each process. So if a product passes through 5 processes, we calculate the cost for every process so that any non-value added activities can be minimized and the cost can be controlled at the process level only, not at the final level. So that is the basically process costing. It's applicable when a product passes through numerous processes. Operating costing is basically in transport, like, per passenger, what is the rate, or in hospitals, per patient bed. Per patient or per bed or per patient bed or per kilometer or per passenger. So operating costing is basically for service industry, right? Again, it's a separate unit. You will be learning detail in the following units. Multiple costing, where more than one method of costing will be applicable. For example, let us say I take the example of bike. So I manufacture bikes, but like a bicycle if I take. I manufacture bicycle also, and I manufacture parts bicycle also. So parts of bicycle, batch costing will be applicable. That means 1,000 parts will be manufactured in one lot, in one batch. And bicycle is a single costing per bicycle. So there is a multiple costing. That means I'm a manufacturer of bicycle also and parts also. So batch costing and single costing, both will be applicable in one organization. So multiple costing means when we assemble also, we manufacture also. So multiple costing can also be applicable in a single organization. All right. Hope we have got the concept. So these are the methods of costing. Then again, the method of costing, I've given the example for sugar industry. If you can see here, for sugar industry, we can have process costing, real estate contract, cold drinks, single costing, like per can or per bottle, what is the price, hospitals, operating costing, hospitals are mostly service industry, advertising, job costing. So I got the advertising order for one company, that is job costing. Car assembly, again multiple costing. So you can assemble the car and you can manufacture the parts of the car also. So multiple costing. So this was just an example to basically further clear the concept. So the techniques of costing. Techniques of costing. Now this is basically the costing. If you remember the first or second slides, we discussed the costing. So costing was the technique or the process. So these are the techniques under which we basically do the cost accounting. Okay. All right. So you have learned all the costing foundation also. All right. Fine. Okay. Now, standard and engineered costs are not the same. Whosoever has asked this, engineered costs are basically have clear cause and effect relationship. Those are not necessarily standard costs. Standard costs are predetermined costs. Engineered costs are actual cost also. All right. So, engineered costs mostly actual cost, the actual cost of raw material, actual cost of the finished product. But standard costs are predetermined costs. So, they are not the same. So, uniform costing is basically when all the companies in one industry follow the same principles or the procedures, that uniform costing. Uniform costing is very relevant because, let us say 10 companies are in the one industry. Let us say airline industry, aviation industry. So in aviation industry, every airline will follow the same method of accounting or cost accounting, same technique. So how is going to help the industry? So all the companies, we have the same technique of costing they are following. So that we can compare between all, we can compare the Air India from Indian Airlines, we can compare the SpiceJet with Indigo. So if any one industry, all the companies are using the uniform costing method, it's always easy to have comparisons that how they feel. So if they are using different techniques, we cannot compare them. We can compare different companies only when they follow the uniform practices or the policy. So that is uniform costing. Marginal costing, as I explained you, marginal costing is basically, and the most important characteristic of marginal costing is it focuses on variable cost because it focuses on unit costing. What is the extra cost I have incurred to produce that extra unit? So I have produced that additional unit. How much will be the additional cost? Additional cost will always be variable because fixed cost never changes with one extra unit. All right. So if I'm already producing 1,000 units and now I'm producing 1,001 unit. So what is the additional cost which is incurred to produce that extra 1 unit? That has to be the variable cost, not the fixed cost. So marginal cost focuses on variable costing. Yeah? It does not focus on fixed cost because marginal costing says fixed cost has to happen. Fixed cost will not change with every additional unit, but variable cost changes with every additional unit. That's why we call marginal costing as variable costing also. All right. So marginal costing focuses on variable cost. Standard costing, variable variance analysis, we have discussed it. Standard costing is the predetermined standards which we have set for every cost. For material, we have predetermined standards for labor, for expenses, for overheads. So, and we compare them with the actual material cost, actual labor cost. Then we basically identify the difference. So the deviation or the variances, the difference between the standard and the actual is called variance analysis. So it's a very, very important analysis, a technique of cost control. So standard costing and variance analysis, again, it's a separate unit in your cost and management accounting, which is very, very important. So marginal costing, again, a separate unit you will be understanding in detail. Standard costing is all about the predetermined standards which are set for every element of cost. And then we compare with the actual cost, and then we do the variance analysis. Variance means the difference between standard and actual. Why the deviation? So the causes of the deviation. All right. Historical costing is all about past data. Historical costing means after the cost is incurred, after I have purchased the machine, I know the cost of the machine. That is historical costing. So historical costing is done after they have been incurred. All right. Post costing is ascertainment of cost after production is completed. Continuous costing is ascertained as soon as the job is completed or even when the job is in progress. So basically, historical costing is, it can be done two ways. My whole production process is completed and then I'm doing historical costing. Let the whole production process be completed, then I will record the material, labor and expenses cost. But continuous costing is, let us say one job is over, so I'm continuously taking, okay, this much material has been incurred. Then now this labor is incurred. So I'm continuously taking recording the cost. That is continuous costing. All right. Absorption costing, the difference between absorption and marginal. Marginal takes care of only variable cost. Absorption takes care of total cost. Under absorption costing, we focus is on total cost. Fixed cost and variable cost, total. Fixed and variable total. Here, so we focus on total cost. We include fixed cost also. So both variable and fixed to operation processes of product. This differs from marginal costing where fixed costs are excluded. All right. So that's the difference between absorption and marginal cost. Under absorption, we absorb total cost, fixed and variable both. So, okay, so that is basically we have covered the whole introduction of cost and management accounting. The introduction part, I've given the overview of different classifications of cost depending upon their behavior or functions or elements. Fixed semi, how to disintegrate semi-variable into fixed and variable. What is the use of IT? What is the scope of cost accounting? What is the objectives of it? And what are the users? And of course, the methods and techniques of costing. All right. So I hope you have understood all the concepts. We can do a quick exercise. You can always post the answer. The first four MCQs are there before you. So if you can just post the right answer, so we can just quickly do it. Just read through the thing and choose the best option that basically explains the question. So quickly you can do it. Okay. All right, good. So question number 1. Which of these is not an objective of cost accounting? Can I have an answer for question number 1, please? No other student? Only one student has given the answer. Okay, 2 students have given the answer. All right. Yes, question number 1, the correct answer is D. So objective of cost accounting is ascertainment of cost, determination of selling price also, cost control and cost reduction also. But yes, assisting shareholders in decision making is not an objective of cost accounting. Yeah, shareholders in decision making. Right. So next, question number 2, a profit center is a center. Option A, B, C or D. A profit center is a center. So which is the option? Yes, question number 2, answer is A, where the manager has the responsibility of generating and maximizing profits. All right. They don't do investment. Profit center don't do investment. Investment centers do investment, right? So answer is B. Question number 3. Responsibility center can be characterized into cost, profit, investment, or cost, profit, and investment. Question number 3. Which is the correct answer? Question number 3. Responsibility center can be characterized into question number 3. Can I have an answer? Yes, 2 is A. Can I have an answer for question number 3? Please mention the question also. Yes, question number 3. The answer is D. Responsibility centers can be cost centers also, profit centers also, and investment centers also. All right. So answer is D for question number 3. Question number 4 quickly. Please mention the question number also, students. Question number 4. Please mention the question number also, not only A, B, C, or D. I will not find out which question you are referring to. Cost unit is defined as answer for question number 4, please. Unit of quantity in relation to, yes. Question number 4 answer is A. Unit of quantity of product, service, time in relation to which cost may be ascertained. So answer is 4. Question number 4 answer is A. Quickly moving to the last slide for the course. Question number 5, the quick answer. Fixed cost is the cost. It is the answer for question number 5. Please mention question number also. A lot of students are giving the answers. Good to know this. Be very careful in answering question number 5. Which changes in total proportion to output, which is partly fixed and partly variable, which do not change in total during a given period, which remains same for each unit of output. Okay, we can take answer number 5D, which remains same for each unit of output. We do not change in total during given period despite changes in output. The correct answer basically is C, which do not change in total during a given period despite changes in output. All right. So see, in the long run, every cost changes, but only for a given period, fixed cost will not change. All right. Question number 6. Question number 6. Uncontrollable costs. Which are uncontrollable costs? Which cannot change, which can change, which may or may not change, or which must change. Question number 6. Can I have an answer for question number 6? Yes, for 5 it should be C answer. For question number 6, can I have an answer quickly? Uncontrollable cost. Yes, question number 6, the answer is A. Very good. Question number 6, the answer is A. Quickly, question number 7. Elements of cost. What are all the elements of cost? Is it only material? Is it only labor? Is it only expenses? Or all of the 3? Quick answer for question number 7, please. Write the question number also. Quick answer for question number 7. Question number 7, okay, good. If the answer is question number 7, the answer is D. Elements of cost are all material, labor, and expenses. All the 3 are the elements of cost. The last question for the session, question number 8. Abnormal cost. Abnormal cost is which cost? Cost which normally incurred, cost not normally incurred, cost which is charged to customer, cost which is included in cost of the product. Question number 8. Question number 8. Yes, 7 is D. Question number 8. Yes, question number 8. The correct answer is B. Cost not normally incurred at a given level of output. All right. So that is basically just the exercise I just included to brush up the concepts which we have just learned from this session. Hope you had a great session. Hope you had a great understanding and learning of the concepts. I think we can share this PPT with the students, Vishu. The PPT, the presentation will be shared to them. There are other exercises also. And so such sort of exercises are the best practice exercises for this session, because it's all the introduction part. No, not so numericals are there in this part. So a lot of practice exercises of this sort you can basically learn to practice these concepts of chapter number 1. All right. So thank you all of you, and thank you for the great response and for all the queries. I hope your all the queries were answered properly. And any issues and any queries, you can always mail to ICI. And of course, I think that they'll be giving you the presentation. So thank you, students. See you soon in another session of another unit. All right. So thank you, and good day to all of you.